again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for our market insights and observations. Today is our 300th episode. We are super excited and thank you for making this all possible. You know, this is a why we do what we do moment at Blanke, Schein Wealth Management. If you thought back 3 years ago, I used to use my little iPhone camera and our YouTube distribution channel to literally come to you, the client, and make certain that we are giving the education and the information in a timely, up-to-date, minute-by-minute approach as we all were locked down, right? So we started this at the very beginning of COVID, simply because headlines were different. We didn't know what we didn't know at the time. But what I did know, and what we do know at Blanke Schein Wealth Management, is you come first, and you are why we do what we do. And just because we couldn't see each other in the office face-to-face, the reality was we figured out a way, and there's always a way to stay connected. Now, that being said, a lot has led us to where we are today. You know, we were doing updates 5 days a week at that time. We've pared it back to 2 days a week. It's a little bit more manageable. At the same time, we had over 73,000 views on our YouTube channel, over 1,700 that have subscribed, and that's well over 12,000 hours of cumulative watch time. So I know it's more than just my mom tuning in. If so, that would be several years of nonstop watching here. The reality is, even if we have one client that is tuning in and we help keep them connected or even to the financial plan, i.e. in their overall investment philosophy, the plan that we've created and customized for that client, the whole idea is, listen, we can't control markets, we can't control a lot of things, but what we can control are making certain that we have a plan, we're sticking to the plan, and we also have sort of that education, that information that provides us because quite frankly, every single one of us, all of our clients and everyone that we serve and want to connect with are very educated in terms of just a smart individual. You just need the information. And oftentimes, we don't love the world of finance as much as I do, and vice versa. If I were to go in a doctor's office, it would be Greek to me, and trust me, my mom always wanted me to be a doctor. That never panned out, and there's great reasons why that worked out for all of us, I assure you. But I love the communication, I love the education on the financial side, and that's what I aim to please here. And I want to increase your, if you will, your daily digital. Everyone says we don't have time in this world today to increase our financial literacy and financial knowledge. That's what we're trying to break through here. The evidence are in the numbers, because we're continuing to see breakthroughs every single day, increased likes, increased subscribers, and more importantly, if we are making a difference in terms of just intelligence for you and confidence for you, it's control, it's knowing that we're here for you, making certain that your current situation in life, your goals and your feelings are connected to your financial plan and the asset allocation accordingly. There's always a story in the asset allocation. Everyone has a different asset allocation and everyone has a personalized approach here at Blanke Schein Wealth Management. So all I ask is like, subscribe, share with everyone else. But thank you for watching and thank you for your dedication. We truly appreciate it. Now let's get down to our 300th episode of Market Insights and Observations. Thanks for watching. So keeping in tradition, I want to start the 300th episode with what we did when we first started our Market Insights and Observations 299 episodes ago, and it's what to watch. In fact, back then, if you recall, headlines on a daily basis, COVID, were crazy. We didn't know what we didn't know, and a lot was scary at that moment in time. More importantly, headlines were confusing, and what I'm going to show you today is headlines are equally confusing, and we're going to go through that. But the what to watch is essentially what we're paying attention to because Wall Street's paying attention to. It's market moving. When markets move, we have to position one way or another in anticipation of that. Not just at the end of the day, you look at the reports and you see, or you log in and you say, oh, market was up or the market was down. Well, there's actually reasons behind it. We do a lot of research, a lot of empirical evidence. We have access, being independent, to a lot of great resources that help us focus as to what's important and what's noise and what you have to basically just disregard as a headline, because there's a lot of clickbait out there. Let's be quite honest with you. Let's go right through it. The most recent entertainers this summer was Taylor Swift. Now, the reason why I'm bringing up Taylor Swift, and I'm also going to show you the student loan debt crisis, is if you will go on to CNBC.com right now, okay, as I filmed and I did some research. I just want to prove it to you in terms of headlines. These two headlines are back to back. Now, Taylor Swift is on a on a tear this summer, fantastic show, and she's basically going to hit or meet and exceed $1 billion. And so the tour concert really is kicking some butt there, and good for her. Now, at the same time, the economy is all about the student loans. Now, there's $1.7 trillion in student loans going to be extracted from the consumer, and starting in October, because the repayment starts for the student loan obligants. But at the same time, the question is that a big bubble? So embedded in this headline are several different things that we have to worry about. There's a bubble in the student loan, which means we're not investing in student loans because we don't have to worry about on the other side whether student loans pay for it or not. But there are some aspects and some vehicles in Wall Street. If you want to be invested in that, God bless you, go for it. But we never have positioned our clients as a result of that. But at the same time, it's also saying there's a weighing in on the economy, something to worry about. That's the headline. They really want you to sort of like tune in and say, hey, what's going to happen in October? Reality is that the consumer's pressured and there's a lot of stress building up in the economy. And the question is, does the consumer have the money? Well, right next door, the answer is there's $1 billion worth of excess wherever somebody gets it, whether the credit card savings that they've had, or they basically just say, it's a birthday gift and they get the money from grandma and grandpa to go see Taylor Swift. There's $1 billion worldwide that actually figured out it's basically the consumer discretion. There is money. The question is it going to go to repayment of student debt, or is it going to go towards Taylor Swift? And that's also to show you that the U.S. economy is still healthy in a lot of ways. But we also have to pay attention to the health of the U.S. economy, i.e., by way of the job market. In fact, the markets moved based upon this exact headline earlier this week. The U.S. job growth slowed to 177,000. Which, oh, by the way, was the slowest in 2 years in the ADP report. Why is the ADP report important? Well, it's basically the one that hasn't been the most reliable indicator of the gold standard, but it has been the gold standard. So it's noticing a slowdown here in what the Federal Reserve is trying to do. They're trying to raise rates, put the brakes on the economy, tell small business owners, which is the engine of hiring in the U.S., so they're asking for sort of little help where if we continue to keep a very prosperous job market, a tight job market, that means the wage growth, the competition to get that, keep that employee or get that employee to come work for you is very tight. That means that the wage inflation, which is inflation that's anchored, that the Federal Reserve is most worried about. So what they're trying to do, and in fact, we've got another employment number for August tomorrow, September 1st, we're going to have the August reading, and we're about a 3.5% unemployment rate. If it ticks up, the market will see it as a sign of relief that the Federal Reserve actually, what they're doing by raising interest rates by 11, 12 times over the last 18 months, that means that there's an impact and it's actually helping slow or cool the job market. Now, when that headline that I just showed you was released, again, the headlines move markets, you just have to know how to sift through them and know what markets are actually going to pay attention to. That's what we're trying to do here with our market insights and observations. The 10-year Treasury in the past 5 days, take a look at this. When that headline was reported about that jobs number coming in weakest in 2 years, the market itself on the 10-year Treasury yields sold off. That means bond prices went up and yields went down. So, we saw 5% on the 10-year Treasury. Now we're in the 4s by the 2-year, even on the 10-year. The 10-year never got that high, but this is the 10-year right now showing that it was earlier in the week just under 4.3%, and now we're down to 409 right now is exactly where the 10-year is as we speak. And it's just showing you. This is a long-term historical average of what we saw actually the last 3 years, if you will, of the 10-year yield coming off their lows. Now, you've got the moving averages, the 50-day, the 200-day we're paying attention to, but ultimately is this trend right here is basically keeping us in a trading range and a support, long-term trend, upward trend, and support for the 10-year Treasury. Why that matters, Rob? Why should I care? Well, in the short term, earlier this week, we saw that the 10-year has sold off, as I just pointed out, but we anticipate structurally the 10-year could hit, the 4%, the 401 number. So we should be watching the 10-year hit that number. Now, if it bounces, meaning stays in this range, okay, that means that the Federal Reserve is keeping the 10-year sort of contained, if you will. If it breaks down further, that means that the Federal Reserve has gone too far with regards to raising interest rates. Something in the economy is not right. The 10-year Treasury will tell us that if it breaks below the 4 handle on the 10-year Treasury. We suspect we could see long-term a trading range. So sort of a trading range over the next few years. Again, it's a Goldilocks number that we're going to see. Or at least anticipate and hope for with regards to the job market tomorrow. But watch the 10-year Treasury. As soon as we get the employment data, watch the 10-year Treasury because that's the movement. And then the equity market, the stock market will be trading as a result of what's happening to the Treasury market. Meaning, if yields are coming down a little bit, that means that we should see the NASDAQ rally or growth stocks rally. Now, we know that there's a global update, that there's cracks in the U.S. economy, as we talked about. China is having some significant growth issues. In fact, we could see China later this year ramp up stimulus to reignite growth in their economy. That's something that could move the markets positively for the globe later this year. We just have to see that slowing get to the point where the Chinese, basically policymakers are going to kick in and they're going to help out. And Europe is already weak. So we know that the effects of the Federal Reserve are the central banks around the world. This is a chart of central banks and showing their interest rate benchmark policy. Blue is the Federal Reserve Bank of the United States, and every other color is basically the ECB, South Korea, Australia, Bank of England, Bank of Japan, and shows on a coordinated effort, everyone's raising rates. So all of the basically countries are raising rates. They had to together, because if one raises rates and the other doesn't, inflation becomes an issue over there. But also the money basically will go towards that country that has the best deal or the highest yielding sort of rate, if you will. So they all have to stay in tandem for the most part, unless there's an issue with that specific country. Again, if we're talking China, we could see them sort of pull some accommodations accordingly. But just look at this chart, how far we've come in such a short period of time. Yes, there is a lag effect and the net cumulative effect of this. You know what? I want to go to, there was another headline. I got another headline that was on CNBC, and it was extremely confusing, essentially just showing you how confusing it was. It was talking about the 10-year Treasury, as well as also talking about one of the Federal Reserve Chairman committee members was saying, I think the Federal Reserve has gone too fast, too quickly, and we could basically stay where we are. Ultimately, what I'm trying to point out is they were contradicting each other. But then let's also pay attention to where there's opportunities. Let's say the 10-year cools off, there's still opportunity in growth stocks. Let's say it continues to persist higher. Well, then we have to be on defense and keep our treasuries, keep rolling them, and keep cash handy, dry powder. Again, both scenarios we have positioned our clients for. Now, another scenario where I've been talking on, Fox Business and CNBC is another position that we think is an opportunity is the energy market. And we really like, even though this summer, this just shows the long-term average of prices, and we've had an average of $76 a barrel this summer. Now we're pushing 80. Bottom line is we could see that go higher because historically speaking, if you look at from Labor Day to Memorial Day, or Memorial Day to Labor Day, if you will, if you see oil prices, historically speaking, sell off, that means by year end, we could see sort of higher prices as a relief rally. Why do we think that is possible? Well, oil counts are going down, the rig counts are going down. You still have a lot of geopolitical tensions with regards to Ukraine and Russia. Russia is now selling their oil. It's not like they're not selling their oil. They are. In case anyone's paying attention, it used to take one day for that oil to make its way around the globe. Now, because of that conflict and the partners not supporting oil from Russia, rightfully so, we see that now take 2 days on average. So that's a supply chain delay that if there's any hiccup in oil by way of supply chain even further, we know supply's down, we could see oil and energy prices rise. And if you look at the OPEC countries, they have really put the lockdown on wanting to make certain that the prices have a floor, and so lockdown on supply. which translates into they want higher prices, and they're going to engineer higher prices, whether it hurts the consumer or not. They want to protect their bottom lines, and this summer hasn't been helpful, but that trend is now reversing in the oil market. So we're adding energy into portfolios simply because it hasn't been the best performing year to date. Technology has, but there's always a mean reversion for the most part in markets. Maybe we're early, but we like that trend as well. So that's our 300th episode. Hope you learned something. Again, like and subscribe. We really appreciate it. And if you have a topic you'd like for us to discuss in greater detail, please just email us, let us know how we're doing and who we can help in the future. I appreciate it. Take care and have a great day.